You know you need life insurance, but the quotes for $1 million or $500,000, they feel totally arbitrary. You're paralyzed by the fear of making the wrong choice, overpaying by hundreds of dollars a month for a policy you don't need, underinsuring, and leaving your spouse and children in a financial catastrophe. So you've done nothing. You've gambled your family's future on a guess. What if I told you can replace that anxiety with mathematical certainty? Forget the vague rules of thumb. We're going to use the DIME formula, the professional secret, to calculate a precise, data-driven figure based on your specific. Grab a notepad. The number we calculate today is the exact lifeline your family would need to stay in their home and keep their future intact. First, D is for debt. This is all personal debt that is not your mortgage. We'll get to the house in a minute. We're talking about car loans, credit card balances, personal loans, and especially private student loans. If you have co-signed debt for a family member, include that too. The goal here is to leave your family debt-free, so they aren't dealing with collectors while they grieve. Add up the total current balances, don't worry about future interest, just the principal you'd want wiped clean. Write that number down. This is your debt number. Second, I is for income. This is the big one, the income replacement for your family. The rule of thumb is to multiply your current annual after-tax income by the number of years you want to replace it. A very common and prudent time frame is 10 years. It gives a surviving spouse a decade to adjust, retrain if necessary, and transition to a new financial reality without a sudden, crushing drop in lifestyle. So, take your annual take-home pay. If you're not sure, a quick estimate is about 75% of your gross salary. Multiply that by 10. For example, if you bring home $60,000 a year, 10 years of replacement is $600,000. This income number can be adjusted. If you have very young children, you might want to cover until they are 18, so you could use 15 or 20 years. But for our quick calculation, 10 years is a strong standard benchmark. Write down your income replacement number. Third, M is for mortgage. This is often the largest single debt. Your family's need for shelter doesn't disappear. The goal here is simple. Provide enough money to completely pay off the mortgage balance. Look at your most recent statement or just use your current remaining balance. This is not your original loan amount, it's what you owe today. Write down that mortgage number. Fourth and finally, E is for education. If you have children or plan to have children and you intend to help fund their college or vocational training, we need to account for that. This is a future expense that your income would have helped cover. A simple way to estimate this is to use a current cost for a public in-state university. Today, that's roughly about $100,000 for a 4-year degree. If you have one child, use $100,000. For 2 children, $200,000. You can adjust this up if you have loftier goals, or down if you expect scholarships or have already started a 529 plan. But for our quick calculation, $100,000 per child is a reasonable, sobering estimate. Write down your education number. Now, here is the simple math. Add them up. Your debt number, plus your income number, plus your mortgage number, plus your education number. That sum is your total financial obligations. This is the gross amount of money it would take to settle your affairs and replace your financial support. But we are not done. We have one crucial step left: subtracting your existing liquid assets. Life insurance shouldn't duplicate what you already have, so we need to account for assets your family could immediately use to cover these costs. This includes your current savings, your emergency fund, and any existing life insurance you already have, such as a policy through your employer. Do not include retirement accounts like your 401k or IRA here, as those are for retirement, and accessing them early comes with heavy penalties and tax consequences. We're talking about truly liquid, available cash. Add up your savings and any existing life insurance death benefits. This is your asset number. Now perform the final calculation. Take your total financial obligations, the big number from the dime edition, and subtract your asset number. The result is your life insurance need. This is the gap between what your family would need and what you already have in place. This number is your target. It might be a larger number than you expected. That's normal. It reflects the true scale of your financial responsibility. Let's talk about what this number means and what to do next. First, this is a calculation for a term life insurance policy. This is pure, straightforward protection for the period of your life when these obligations exist, while you have a mortgage, while your kids are at home, while you are building your career. A 20 or 30-year term policy is the perfect, affordable tool to cover this gap. Second, if the final number feels overwhelmingly large, don't panic. You can adjust the variables. Maybe you start with a 7-year income replacement instead of 10. Perhaps you decide to cover only half the mortgage, with the understanding your spouse could refinance. The calculation isn't a prison sentence. It's a tool for awareness. It shows you the levers. The biggest ones are usually the income replacement years and the mortgage. Even if you can't insure for the full amount right now, insuring for part of it is infinitely better than insuring for none of it. You can always add more coverage later. There you have it. You've moved from confusion and guesswork to clarity. You have a data-driven starting point. You haven't just picked a number out of thin air. You've calculated a need based on the real architecture of your life, your debts, your income, your home, and the dreams for your children's future. Now you can shop for quotes with confidence, knowing what you're really trying to protect. Take this number, get term life insurance quotes, and secure the peace of mind that comes from knowing you've done the math for the people you love.